If you're a beginner just starting out, I'm going to advise that you watch this particular video till the end. And if you're an intermediate trader still struggling with markets, struggling with profitability, I'm going to advise that you watch this particular video till the end because this might be the missing piece in your trading journey. In this video, I'm going to be explaining structure to the barest minimum. I'm going to be explaining every detail you need to know about structure. So when we talk about structure, now before I go straight into structure, if you are analyzing with your MetaTrader 5, you can analyze on TradingView for Deriv, in as much as there are some restrictions that you're going to face, for instance, with the time frame and some other things. I'm going to advise that you use the TradingView to analyze your trade. Okay, and where you can get the TradingView is not the normal TradingView. You're going to get it on charts.deriv.com/deriv. This is where you're going to be getting the TradingView. Now, when we talk about analyzing on TradingView, it gives you more cleaner analysis. It lets you see into the bigger picture. That is what TradingView does for you. So I'm going to advise that you use the TradingView for analysis. So let's get straight into what we want to discuss, which is structure. Now, when we talk about structure, what does structure really mean? You should have asked yourself that question. What's the importance of structure, or what does structure actually mean? Now, each of these candles that you see here, if you check each of these candles, they are information. Each of the candles are not just formed just because it wants to form or anything. They are information. Now, market structure is the combination of all these candlesticks into forming a pattern. Market structure is the combination of all this information. You can see that each of the candlesticks represents something. There is an information in each of the candlesticks. Forget about the candlestick for buys, the candlestick for sales. Let's push that aside for now. But each of the candlesticks that you see here has a lot of information in it. And market structure is now the combination of all this information in us into forming a pattern. Market structure is pattern. If a pattern has been generated before, when you see the same pattern, you can easily trace back to what has happened in the past. That is what market structure does for you. And if you do not understand in-depth of market structure, you are going to fail. Let's be realistic here. You're going to fail if you don't understand in-depth of market structure. Let's go into market structure directly. Now, basically, we have two types of structure, okay? We have two types of structure. In the normal sense, we have two types of structure. We have the trending structure and we have the ranging structure. We have the trending and we have the ranging. For the trending, just as the name implies, it means that the market is in constant movement into a particular direction. That is what trending means. The market is in a constant movement towards a particular direction. That is what trending mean. While ranging is that there is a movement, but just towards one side. Market is not moving towards a direction. It is not moving up and it is not coming down. It is just moving sideways. That is what we call ranging. But in this video, I'm going to be focusing on just the trending because that is the most important thing that you need to know about the pattern of the market. So under trending, we have two types. Under trending markets, we have two types. We have downtrend and we have uptrend. We have downtrend and we have uptrend. When we talk about uptrend, just as the name implies, remember trending means a constant movement towards a particular direction. Now, if we had the up, it means that the market is in constant movement towards the upside. That is what we call uptrend. Now, downtrend, just as we explained trending, it means it is in a constant direction towards a particular side. Now, when we had the down, it means market is in a constant movement towards the downside. That is, it is going down. Now, if market is going up and you are trying to go down, what do you think that will mean? You will fail woefully. If market is going up and you are saying, oh, what I want to do is to come down, you will be isolated. People are going up, you are coming down, you will be totally isolated. That is why it is really important that when market is moving to the upside, you join the trend. You move to the upside. Now, let's see the representation of how market moves to the upside. Now, when we say something is in a constant movement to the upside, it is something like this, right? Market is just, trending to the upside. But if market is represented with something like this, it means we don't even have to learn anything about trading. Because immediately you see that market is going up, you just jump in and you enter, right? That is what it means. But there are two things trending market does. It moves up, it comes down. It moves up, it comes down. Now, this is because we have buyers and we have sellers in the market. No matter what you do, buyers will not finish in the market. No matter what you do, sellers will not finish in the market. They will be in the market at the same time. Just that some people might have a strong hand. It might be the buyers that will have a strong hand. It might be the sellers that will have a strong hand. When the buyers are having strong hand, that is when we move to the upside. But when the sellers have the strong hand, that is when we move to the downside. Remember I said, no matter what you do, buyers will not finish in the market, sellers will not finish in the market. Both of them will be in the market at the same time. For every buyer, there is always a seller. If I am selling something, I need a buyer to buy it from me. If I am selling, I need somebody to buy it from me. That is why you will constantly see them in the market. And that is why we have a representation of higher high, higher low for an uptrend. Higher high, higher low. Higher high, higher low. Higher high. Now, you can see that in as much as there are sellers in the market is still moving to the upside. It is just like climbing a staircase. It is just like you climbing a staircase. You want to continually go to the upside, right? So we have buyers in the market. It just got to a point the sellers decide to take over in the market for a short period of time, and we have what we call pullback. There is a pullback to the downside. Now we have another move to the upside. This is when buyers take control of the market. They push the market forward. They push the market to the upside, right? This is when buyers has a strong hand in the market. They push it to the upside. At a point, the sellers take it again. They give us something we call pullback. Now, we now have two representation here. We have impulse. This movement to the upside, we call it impulse. Take note of this. This movement to the upside, we call it impulse. This movement to the downside, we call it pullback or retracement. Impulse, retracement. Impulse, retracement. Impulse. You can see that for every of the high that is created, it is higher than the previous high. That is when you know that we are in an uptrend. So we have this, right? We will call it break of structure. If market violates the previous high, we will call it break of structure in an uptrend. If we violate the previous high, we call it break of market structure, represented as BOS. Okay, we have a pullback to the downside. Now, this low has to be higher than the previous low. This particular low must be higher than the previous low for you to call it a higher low. We call it higher low. So we have something like this. We have higher high, higher low. Let's represent that with a text. We have higher high represented with HH. Then we have higher low represented with HL. Okay, we have higher high, higher low represented with HH, higher high, higher low. Now this next low has to be higher than the previous higher low. That is when you know the market is moving up, and we need to have a break to the upside for every movement. For every movement that you see in the market in an uptrend, we are expecting market to break the previous high. That is when you will know that you are going up. Market has to break the previous high and reserve this previous low. So we need higher low. The next low has to be higher than the previous low. The next high has to be higher than the previous high. Now, there's one thing you need to know. If we don't have a break to the upside, if market does not break the previous high, you must not call the low created higher low. This is what I mean. If we are stuck somewhere like this, and market does not break this particular high, if market does not break this particular high, there is no reason you should call this low higher low. Remember, we are expecting market to preserve the lows. We are expecting market to preserve the higher lows. There are sometimes if we don't have this broken to the upside, market will do what? Come back and break this previous low. I'm going to tell you what it means if market breaks a particular low in an uptrend or it breaks a particular high in a downtrend. So you can see that this low has been taken. Now, when we now have a break to the upside, the lowest low before we hatch that break to the upside is what we will call the higher low. Now, let's look at the downtrend. Let's look at the down aspect of it. We have something like this, a low, a high. We have a low, a high. Now, downtrend is often represented with what we call lower high, lower low. Lower high, lower low, meaning that our highs need to be preserved. This high needs to be preserved, and market has to break the lows. If you are trending to the downside, market has to break the lows while preserving the highs. We don't expect market to come back and break the high. You can see that we had another break of structure to the downside. We call it break of structure, okay? This is break of structure to the downside. When we are in a downtrend and market breaks the low, we call it break of structure. So we are expecting market to preserve this high. Any higher low or any lower high created must not be higher than this. We expect market to just create a low, but not come back to take this low or to take this high. We just expect market to create a high and proceed to moving to the downside. Okay, so this is an uptrend represented with higher high, higher low, higher high, higher low. Then this is a downtrend represented with lower low, lower high, lower low, lower high. Now you should ask the question that, okay, what if, just what if market breaks this high to the upside? What if this lower high, the last lower high, market just breaks it to the upside? What do we call it, or how should you go about it? Now, when we mistakenly, I'll call it a mistake, and I will tell you the reason. When market takes this high to the upside in a downtrend, we call this change of character. We call it change of character. The reason we call it change of character is because you can see we are in a downtrend, and all of a sudden, market just takes out this high. Now, let me cite a great example for you to know exactly where I'm driving to. It is just like you going upstairs, or let's say going upstairs. It's just like you going upstairs. You are climbing the stairs, right? And all of a sudden, you know, you are climbing up. All of a sudden, your leg slipped. Your leg slipped back to the previous stairs. What will you call that? Will you say because of that, you are not going up again, you want to start going down? Absolutely not. Your leg slipped, and if you want to continue going up, you will continue going up. And that is exactly what we have here. If market breaks this low, we will call it a change of character, but that does not mean that market wants to start going down. Sometimes it will still continue to go up. As a beginner, you're going to learn all of this pretty soon. I'm still going to explain this particular concept, the difference between break of structure and change of character. But I just need you to understand this, that when we have the first violation in an uptrend, that is when market breaks the higher low, the first higher low broken, we don't call it break of structure, we call it change of character. Remember that if you are trending to the upside and market is breaking the high, we call it BOS. BOS, we call it break of market structure. Also for a downtrend, if we keep trending to the downside, if market keeps breaking the low, we call it BOS, which is break of market structure. Let's show this on charts. Then in our next session for beginner series, we are going to talk about the difference between break of structure and change of character. Before then, let's just go on chart and explain what we've done so far. So let's open our chart. This is an uptrend. See what we had here. We had a low, a high. You can see that we have another low. Market came back and gave us what? Break to the upside, a low, a high, a low. You can see a high, a low, a high, a low, a high, a low, a high. It is really clear that we are in an uptrend. That is, market is moving up. Market is moving up. And we are going to call this movement to the upside, we call it impulse. This movement to the downside, we call it retracement. Movement to the upside, we call it impulse. Movement to the downside, we call it retracement. Impulse, retracement. Impulse, retracement. Impulse, retracement. Impulse, retracement. Impulse, retracement. Then we have impulse, retracement. We still came back and gave us a retracement, then impulse to the upside. That is an impulse to the upside. You can see that market is moving up, and we continue protecting the low. So it means this is higher low, higher low, higher low. This is higher low. This low is higher low. This low here. This low is also higher low. This low is higher low. This low is higher low. And we continue breaking the highs. That is when you know that we are moving up. It is so obvious that what we are doing here is moving up. You don't have to panic. In our beginner series, we are going to explain all of these things and you will understand clearly. Now, this is a downtrend, right? We have a low, a high, a low, a high, a low, a high, a low, a high, a low. You can see that we keep breaking the low while we keep preserving the highs. Market keeps breaking the lows and keep preserving the highs. Market is just reserving the highs because we are going down. So it means impulse, retracement, impulse, retracement. Any buy movements you see in a downtrend, we call it retracement or pull back. In our next class, I'm going to explain break of structure, change of character, their differences, their similarities, and then traded. Do not forget to follow and subscribe to this particular channel.